Hi, this is Afaf Noor, and this is a debrief of Section A from the Audit and Assurance mock exam. The key exam technique for Section A questions in Audit and Assurance is making sure that you read through the scenario very carefully, use the highlight function to identify key parts of the information before you start reading the questions and the options. So I'm assuming you would have read through the entire scenario. We will start off with the first question related to this scenario. The question asks for two initial actions that the firm should take now that the client has refused to let the firm circularize the new bank. The key part of this requirement is initial action. So remember, that's what we have to focus on. The first option says send the bank confirmation request without management's permission. That is incorrect because the bank is not going to respond if we send them a letter without their permission, which is not on the client's letterhead. We will have to re-evaluate the risk of material misstatement. This is an identified inability to obtain sufficient appropriate evidence. I'm now concerned that the client has something to hide, so fraud risk increases. So that's the correct option. Revise the audit plan and consider alternative procedures. That's also correct. When we have a scope limitation or we've been restricted from obtaining certain evidence, we will have to look at the audit plan, revise it, and look for any alternative procedures that can be carried out. In our example, this could potentially mean looking at the bank statement, for example. The last option, which says issue a disclaimer of opinion as there is insufficient evidence available, is not the correct initial action. This might be the ultimate thing that we end up doing towards the end, but we cannot come to this conclusion before we have tried to carry out alternative procedures. So we might actually end up giving a qualified except for or disclaimer of opinion at the end, but this is not an initial action that's going to be carried out. The next question relates to the new long-term loan that the client has taken out during the year. The requirement asks for the procedures that should be performed to confirm the loan liability balance at the year end. So I've highlighted balance at the year end. I'm going to make sure I do not read through the requirement in a rush so that I know exactly what is being asked. So I basically have to confirm the closing liability in the statement of financial position. If I read through the first option, looking at the board minutes for evidence of approval of external finance is not going to help us confirm the year-end balance. So I can say for sure that first option cannot be the right answer. And with this, I can automatically rule out these two options because I'm quite certain the first one isn't correct. So this is a very easy way of ruling out options, particularly in questions which are giving you a bit of trouble. Agree the loan payments recorded in the general ledger to the bank statement to confirm the amount that has been repaid. Again, you would have had, like, of course, loan received during the year, then repayments made, and then the closing balance. So this is a very valid procedure for confirming the year-end balance, which is still outstanding. Agreed the year-end loan liability balance to the bank confirmation letter. That is also a very good source of third-party evidence, so that's also correct. Again, the minute I see that 2 and 3 are the right answers, I am actually pretty much quite certain that I have the right answer, but please do not stop. Make sure you read through all the options before you choose the correct answer. Finally, comparing loan liabilities at the end of the year to balance in the previous year is not a relevant procedure, mainly because they have mentioned that they have sourced external finance for the first time during the year. There is going to be no prior year balance. So 4 is incorrect, and with that, I'm quite certain that the options are 2 and 3. The third question relates to the rights issue that has been undertaken during the year. The requirement asks for audit procedures that will provide evidence regarding the accuracy, valuation, and allocation of share capital. Now, in the exam, before I go and read the options, I need to make sure I'm very clear on what this assertion means. This is an assertion which relates to account balances and related disclosures, where auditors will basically test to confirm that the financial statement amounts and the related disclosures are correctly given. So with that in mind, let's start reading the first option. Review board meeting minutes to identify matters relating to share capital, including ensuring proper authority was given for the rights issue, is not valid. Remember, we're confirming the amount and related information in the disclosure regarding this particular rights issue. Approval of this share capital or rights issue is not going to help me confirm that amount that has been recorded. So the first one is ruled out, and with that, I can easily say that the first two options cannot be correct because they have the first statement in their option or the answer. Looking at the second one, agree the number of authorized shares disclosed in the notes to the financial statements to Northgate's constitution documents is again not valid. They are confirming the information regarding the authorized share capital and they're matching it to the articles or memorandum of association or other constitution documents, and this cannot help the auditor confirm the accuracy or valuation of this particular rights issue. So 2 is also ruled out, and with that I can quite certainly say the option is the last one. But like I said earlier, I am going to make sure that I read through the remaining options even if I'm 100% certain. Agree closing share capital balances in the trial balance to statutory records and the draft financial statements is correct, and inspecting the bank ledger account to confirm cash receipts from the rights issue that they have been completely and accurately recorded is also correct. Both procedures 3 and 4 will help us confirm the accuracy and valuation of the double entry and disclosures. So the answer to this question is statements 3 and 4. Just very quickly, bank ledger account is another term that we use for the cash book. Question number 4 relates to the wages and salaries information that is given. We don't really have to use the scenario for this one. This is basically a knowledge-based question, testing your understanding of analytical procedures. Remember, when we talk about substantive procedures, there are two main kinds. We have tests of details and we have substantive analytical procedures. Analytical procedures are where we carry out comparisons with the industry, with prior information, with budgets, etc., and investigate any significant differences. So with that concept in mind, I'm going to read through the options. Recalculation of gross and net pay for a sample of employees and matching it to payroll records is a test of detail, so that's ruled out. Comparison of current year expense with the prior year is a substantive analytical procedure. If there's a significant difference between the two expenses for the year, this will be looked into. Agreeing the total net pay per the records to the bank transfer list and the bank ledger account is again a test of detail. So that's also incorrect. The last option is carrying out a proof in total calculation and comparing the expected expense to actual expense reported in the draft financial statement is an example of an analytical procedure. Now, proof in total is where auditors carry out their own rough calculations, come up with an expected expense for the year and comparing it to the one that has been recorded in the financial statements by the client. So for example, I could be taking last year's expense, add in any new employees, take out the salary of any employees, those who have left, maybe put in any increments and come up with a rough amount that you can compare to the one that has been recorded by the client. So that's a proof in total, and that's an example of an analytical procedure. The last question that is related to this scenario is about the bonus accrual, and this is slightly more technical. Which of the following procedures would not test for understatement of the bonus accrual in the statement of financial position? So we're talking about the accrual, which is our liability. Understatement means we are going to be thinking about procedures that do or do not confirm completeness. So remember, we have accuracy, we have occurrence, we have completeness, we have cutoff, but this one in particular is asking about procedures that are not relevant for confirming the completeness of that liability. Starting with the first one, agree the payment of the bonus from post year-end bank statement to the accrual is a valid procedure. So for example, if the accrual was 7 million and the post year-end payment was 7.5 million, we would know that the liability at the year-end was incomplete. So that's a valid procedure. Agree the bonus from the payroll records to the accrual listing, which is again valid. If the records say the accrual should have been, say, 8 million, and the listing actually records 7 million, we would again know that the liability has been incompletely recorded and is understated. So that's correct. Compare the accrual to the budget and last year is a valid substantive analytical procedure for completeness. It's the last one which is incorrect. Selecting a sample of employees from the bonus listing and recalculating their bonus is primarily testing for accuracy. So recalculation is mainly done for arithmetical accuracy. So therefore, this is not a valid procedure for completeness. We're going to look at another question from section B of the mock exam. Again, I'm assuming you would have read through the scenario, highlighted the key information, and we will start off with the first question related to this scenario straight away. Which two of the following corporate governance principles should the client be complying with? So I've read through the scenario. The firm has been the auditor for the last 7 years. The board has decided that the client will be listed on the stock exchange within the next 4 years, and they have asked for advice on how to achieve compliance with corporate governance principles. The question is testing your understanding of these best practice guidelines. The remuneration committee should be composed of independent non-executive directors. That is correct. Remember, this committee should be made up of entirely NEDs because they are the ones who are going to be setting the executive management's remuneration. The chief executive officer should be responsible for the leadership of the board and ensuring its effectiveness. That is incorrect. That should be the chairman. So an easier way to remember this is by thinking and understanding that it's the chairman who really runs the board and the CEO ultimately runs the company. So this is something we sort of say in practical life. It'll be easier for you to understand. So the second option is incorrect. It is the chairman, not the CEO, who is responsible for the leadership of the board. So the key part over here was the word the board. The non-executive directors should provide constructive challenge and strategic guidance. This is correct. This is one of their roles. Remember, they bring independent scrutiny to the board and they challenge the information that is presented to them and the decisions that are being taken. So the third one is the right option. The audit committee should appoint and approve the external auditor. Now, this had to be read very carefully. The audit committee does give recommendations, but the ultimate approval comes from the shareholder. So because the word recommendation was not there, the last option is also incorrect. Moving on to the next question, which of the following factors should be considered before the firm can accept the client's internal audit engagement? Now, as I was reading through the scenario, I would have read through this information. The board is considering establishing an internal audit function and they want to outsource it to the audit firm. Now, which of these factors need to be considered? Please make sure you read through the options very carefully. whether the external audit team has the expertise to carry out the internal audit work is irrelevant, because even if I do end up accepting this engagement, this is going to be done by a completely different team. So the external audit team's experience or competence is not relevant. So the minute the first option is ruled out, I know option D is not the right answer. I still have to choose from the remaining three. If the engagement or the assignment will relate to the internal controls over financial reporting, that is correct. Remember, if the engagement relates to financial reporting, then this is a self-review threat and this will need to be managed. And if management will accept responsibility for implementing appropriate recommendations, this is also a valid consideration, because remember, as auditors, we cannot accept any engagement where we end up working like the management or taking management related decisions. So both these factors have to be considered. The option or the correct option is statement 2 and 3 only. The next question also relates to internal audit. Which of the following would result in the firm assuming a management responsibility in relation to the internal audit services? Remember, management responsibility is when the auditor is controlling or leading and directing the client, or they're making decisions about any of its resources. So with that concept in mind, let's start reading through the options. We're looking for services, which could mean that the auditor is acting like the management. Taking responsibility for designing and maintaining internal control is going to be a part of management responsibility. Determining whether the work of internal audit function can be used to obtain audit evidence is not a relevant point, because this has nothing to do with the management. This is an audit judgment that auditors take during the course of their external audit. So statement 2 has nothing to do with assuming or taking up management responsibility. So with statement 2 being ruled out, I know these three can't be the right option. Let's read the last one, setting the scope of the internal audit work to be carried out. So setting the scope means deciding exactly what work needs to be done. Again, if I end up doing this, this will be assuming management responsibility. So the answer to this question is statements 1 and 3. This question relates to a different client and tests your understanding of the code of ethics. Now, this client, Fabitco, is a listed company, and the firm has identified that fee from this client for audit and other services is going to be 16% of the firm's total income for this year, and this is in comparison to 15.5% in the prior year. The audit engagement partner has asked you to consider safeguards to address the self-interest threat. So remember, when we have fee dependence, there is a self-interest threat, and the guidelines for listed clients or public interest clients are slightly more strict. So if for 2 consecutive years there is a dependence which is 15% or more of the firm's annual income, we will have to implement certain safeguards. With that knowledge, we will have to choose the correct answer. Disclosing this information to the firm's ethics partner is a valid action, but this is not a safeguard that is adequate on its own. So this alone, or this in particular, cannot act as a safeguard. It is, of course, an action that will be taken. A pre-issuance review equivalent to an engagement quality review is the right answer. A pre-issuance review is basically getting a review done before the audit report is signed. Remember, this is a listed client. They would be getting an independent partner review done in any case. So this pre-issuance review is going to be done by someone external to the firm. So the second option is correct. Using professionals who are not audit team members to perform the non-audit services will not basically help in safeguarding self-interest because of fee dependence, right? Because at the end of the day, it's the same firm. Even if it's a different team, it's the same firm, so this cannot safeguard the self-interest threat. And a post-issuance review by the engagement partner is again not a valid safeguard because the engagement partner is the one whose independence is going to be compromised. That's the first reason. And the second one being this is not a valid safeguard which is given by the code. So post-issuance review is not a valid safeguard. The next question again relates to a different client. This is a listed company and the management is planning to develop a new website to offer online sales to its customers, and they have asked the firm if they can provide assistance with the design and implementation of the website and online sales system. Please make sure you highlight the key parts of the information. This is a listed client and they're basically asking for IT services. So this is important. You will have to recall what the code says about this. And with that concept in mind, let's read through the requirement. Indicate whether each of the following statements regarding the provision of assistance to this client is true or false. A familiarity threat arises as the new systems will produce data which will be used directly in the preparation of financial statements. This is incorrect because that would be self-review, not familiarity. There's a risk that the firm may assume management responsibility if they become involved in making management decisions. That's correct. Management responsibility is an issue that needs to be considered for most other services that are given to audit clients. There will be a heightened or increased self-review threat because of auditors' reliance on controls testing and on analytical review of the data summaries generated by the new system. Again, this is a valid point because when in later audits, the auditors look at that data, the system that they've helped design, there is going to be a self-review threat. So that's also valid. The firm should use a separate team made up of non-audit staff to carry out the work and get an independent review done. Now, this would have been the right answer had this not been a listed company. For listed companies, when the self-review threat is this significant, no safeguard is possible and this service cannot be provided. So we cannot apply this as a safeguard because for listed clients, this is simply not allowed. Let's look at another question from section A of the mock exam. Again, as you read through the information the first time, you would have highlighted key parts of the information. We are going to start by looking at the first question. Now, ISA 560 requires that auditors should perform audit procedures to identify subsequent events. The period covered by this review started on the 1st of April. Which of the following dates is the end of the period covered by the subsequent events review? Now, just quickly recapping, we have the year end, we have the date financial statements are approved by the board of directors, we have the date when external auditors sign their audit report, and then we have the date when we have the annual general meeting and financial statements are issued to the shareholders. Based on our auditing knowledge, we know that from the year end until the auditor's report is signed, the auditors have something that we normally refer to as active duty. This means they do need to carry out procedures to identify events which might require an adjustment or disclosure in the financial statements. So when you start reading through the option, it is the third one which is correct. So auditor's responsibilities to identify subsequent event is from the 1st of April until the date when the auditor's report will be signed. The client's year end is the 31st of March, so it starts from the year end until the auditor's report is signed. The remaining three options are incorrect and therefore based on this basic knowledge, I could get these easy 2 marks in the AA exam. Assuming that I've read the scenario carefully, I'm going to use my financial reporting knowledge to answer this question. Indicate whether events 1 and 2 will be classified as adjusting or non-adjusting events. Remember, it is going to be an adjusting event if the condition existed at the year end, but we found out about this later. So think of it like this in very simple terms. So the client's year end is the 31st of March. Event 1 occurred on the 10th of April. Springs in new types of mattresses have been found to be defective, making the mattress unsafe for use. There has been no sales of this mattress, and it was due to be marketed in a few weeks, but nothing has been sold. The company's insurance company estimates that the inventory value of 750,000 has been affected, and this is now only worth 225. So we have inventory at the year end recorded at 750, and we now know that because of conditions which did exist at the year end, the worth of the value or the NRV of this inventory is 225,000. So this is an adjusting event, and I would sort of confirm this after I've read through the entire scenario. All this inventory was in the finished goods store at the end of the year. So all that information is given. With event 2, this occurred on the 5th of June. Production at a factory was stopped for 1 day because of an event that happened. There's been a spill of the dye into the local river. The environmental agency is currently considering whether the release of dye was in breach of environmental regulation. So the condition, which is the spill really, did not exist at the year end, and therefore this is a non-adjusting event. So again, this requirement was primarily focused on testing your financial reporting knowledge. We'll have to make sure we read each part of the requirement very carefully because this is going to be slightly technical. So indicate whether each of the following audit procedures are valid or not valid in relation to event 1. So remember, in event 1 is where the inventory probably needs to be written down, and they've given us quite a bit of information that needs to be audited or confirmed. Obtain confirmation from the insurer of the amount recoverable under the policy. That is a valid procedure. Remember, this part of the information is given in the scenario. We are the auditors, we have to confirm this. So the insurers have estimated that the NRV is now 225,000. They've also said that we can't get any money from the supplier because the supplier is in liquidation, and the insurance company will not be giving any money to the client because the client was underinsured. So this part of the information is given in the scenario. I will have to carry out this procedure to confirm the value of 225 because remember, we are going to ask the client to adjust the financial statements. Inspect correspondence with the supplier concerning their solvency. This is again a valid procedure. They have told us that the supplier has gone into liquidation. We need to confirm this by looking at correspondence or communication between the supplier and the client. Because it is about writing down the value of inventory to its net realizable value, recalculation of NRV is a valid procedure. Review post year-end physical counts of mattress is not going to be valid because the defect relates to things or conditions that happened before or at the year end. So whatever happened after the year end is not valid to this situation. So this is not relevant. And inspect subsequent cash receipts from sale of defective inventory. Again, this is not valid because no sales have happened as of now. The question does specify that no movements of inventory have been recorded post year end. So this is not a valid procedure for event 1 that the auditors will carry out. The next question relates to event 2, which, if you remember, was a non-adjusting event. Which of the following audit procedures should be carried out on event 2? Inquire of the directors whether they will recognize a provision for a fine in the financial statements is incorrect. Now, if we read through the scenario in a hurry, we might miss this keyword. We've already said it's a non-adjusting event, which means the numbers in the financial statements do not change. So the statement of financial position and statement of profit or loss is not going to be affected. So a provision is not going to be recorded. That's invalid. And with that, I can easily rule out the remaining three options. But remember, we are still going to read the rest of the options given. Obtain board minutes to determine the extent of damage. That's correct. Inspect the actual legislation and any interim reports from the agency to determine the extent of damage. Remember, this is important because if non-adjusting events are material, they will need to be disclosed in the financial statements. So to determine that materiality, that judgment has to be made based on the extent of damage that has happened. We then have another question related to a different period of time. The auditor's report was signed on the planned date and an unmodified opinion was given. It is now the 20th of July. So remember, we started off on the 1st of July and the year end was 31st of March. And until question number 4 of this question, we were talking about things and audit work that had been done before the audit report was signed. Now we've gone into the future. We're at a different point in time now. So the report has been signed and unmodified opinion was issued. It is now the 20th of July. The annual general meeting is taking place on the 21st of August. The agency has issued a report stating that the client is in breach of environmental legislation and a fine of 900,000 will need to be paid and the amount is material. So now this is a material event that should have been disclosed in the financial statements. Remember, the audit report has already been signed. Which of the following procedures should not be performed in respect of this fine? We've signed the report. Let's start looking at the options. Discuss the matters with the directors to determine their course of action. That's the first thing we'll do. So my first question to the directors will be, what is your plan? Are you actually going to now change the financial statements and add that disclosure? We will need to determine whether the financial statements need amendment. Remember, amendment does not just mean a double entry. Financial statements do include notes to the account. So adding a disclosure is also an amendment. So amendment could be in numbers, amendment could be in disclosures. If the directors amend the disclosures in the financial statements, we add an emphasis of matter paragraph in the auditor's existing report. Please do not rush through reading this scenario. The key word was existing report. Remember, we gave the auditor's report on the financial statements that were approved a while ago. We cannot make amendment to the same audit report. We will have to issue a new or a changed one. So answer C is incorrect. If the auditors decide not to amend the disclosure in the financial statements, we have the right to speak at the annual general meeting to inform the shareholders of the facts. That is correct. Because the AGM has not yet taken place, if the directors do not change the financial statements to add that disclosure, we cannot issue a new audit report, but we do have a legal right to attend the annual general meeting and communicate this to the shareholders. So the correct answer to this one is option C. The key point to remember for Section A questions in audit and assurance is that if we rush through reading the scenario or the requirements, there is a high chance that we miss key parts of the information and we could end up getting our answers wrong. The examiners have fed back to say that if you're spending, say, about 1 minute on one question in Section A, this basically means there's a high likelihood that you're getting your options wrong. So please do make sure you read the information very carefully before you choose your answer.